Good evening. Welcome to another edition of the ShadowTrader Video Weekly for Sunday, February 14th, Valentine's Day. Shout out to all the lovers out there. This week we're going to talk about technical analysis, specifically in the context of a very large balance area in the markets. I'm going to teach you about a concept called balance rules and also something called spike rules. I've talked about these before in the video, and I think they're extremely important for traders to understand because they give us a framework from which to trade from that really eliminates a lot of the shock and awe or wondering why certain moves happen or what's going on in the market. If you have at least a better idea of what is actually happening, you'll be that much better prepared to profit from it, all right? We're going to delve a little bit deeper into sectors this week, getting more granular. After we look at the TA, we'll go a little bit lower in our hierarchy, and we'll look at some of the sectors in the S&P, which I think are absolutely confirming this rally, and to me are pointing to at least continuing throughout the month of February thus far. We're also going to talk about market profile, where you're going to get to see that balance area that I talked about a lot clearer, because that profile chart is going to show us value and not just time and price. Then after that, we're going to get into a trade of the week, where I'm going to teach you an adjustment that you can make to a ratio spread to turn a trade that would have been just a break even into a solid winner. And last but not least, I'll go through just a small handful of charts that I think could be moving in the weeks to come. All right, without further ado, let's get into it. Let's begin with some basic technical analysis as we like to start here on the S&P. So I'm going to talk about this balance area shortly, but I want to talk more about it when I show you the market profile, because you'll see it so much clearer there, because you can obviously see where value has developed as opposed to just where price is, since the candlestick charts are a little bit two-dimensional. So just keeping it in terms of a technical analysis type view, we're still well above the 20, well above the 50, so everything looks fine there. Obviously, there's absolutely nothing bearish about this chart. If we flip over to NDX, it's the same thing. We have absolute just bullish activity, also kind of balancing to higher. And where it gets a little bit more interesting, I think, is in the Russell, because this is, I think, is what's going to give us a lot of clues as to what's going to happen next week, is the fact that this was really quite an overbought situation in the rut as far as being overextended from the 20-period moving average and so many days straight up. And yet, look what happened since then. There was literally one day of pullback and then nothing, and you had this tight consolidation up at the high. So obviously, the rut is consolidating more by time than price, and that's very, very bullish. Could it still fall out of bed here? Of course, any market can do anything it wants at any time. I mean, we should always remind ourselves, or at least in the context of this chart, remind ourselves that the market was balancing to higher here and then had a liquidation break here because it just needed to test that 20 MA. So of course that could happen, but for all intents and purposes, for the most part, just, we can only go by what information we have right in front of us. And this is obviously bullish that these small caps that seem to be leading the rally are not pulling back at all. Now, if we get a little bit more granular in terms of what the sectors are inside of the S&P, and as I always say, I only like to look at the top 5, 6, or 7 or so, because of the 11 sectors, remember 4 of them at the bottom, which is the materials, the energy, real estate, etc. Those have such little weight in terms of what happens in the S&P. So the largest weight in the S&P is XLK. So it's no big surprise that technology, which this ETF represents, is just grinding sideways to higher. So it's going to mirror the S&P, it's going to mirror the NDX. But when you look a little bit deeper at some of the others, such as healthcare, which is a big part of the S&P. Notice that you had a very large balance area here in healthcare, and you're just now starting to break out of that balance area in healthcare. And that's bullish, because notice that you've got room to go to get up here. And what should it do? As we always say, you take the amount of the balance area and you double it. So we could easily see healthcare stocks grinding their way up to those prior highs. And of course, why is that important? Because they are about 14% of the S&P 500, and it's just going to be another catalyst to bring the S&P a bit higher over time. Let's continue on with communications, XLC, another one. So, I mean, undeniable, right? I mean, bullish. It's absolutely just ripping. Is there danger of pullback here? Of course, you got to remember stuff like that. Remember, we're just looking at these different sectors in terms of the contextual information that they give us because of their weight in the S&P, right? Obviously, everything, the S&P is made up of 11 sectors, and we're looking at the top 6 or 7 sectors that carry the most weight in the S&P, and we're looking at their chart patterns to give us an idea as to, you know, whether or not the S&P is going to continue higher or if it should turn a bit. Let's look at another one here, XLY, which is the consumer discretionary. That's pulled back a little bit this week, but again, I think that's good because remember, you need some push-pull. There's always it's always good when you have a little bit of, you know, money coming out of one area going into another area, and then the net effect is that it's still keeping that index higher. And let's look at just two more. We'll just look at financial and industrial. Financial, I love this pattern because it's 100% retracement of the prior move down, right? You have this move to here and this move to here, that's 100%. So what I always say is when this happens, there's almost no chance of 100% retracement back down. It just doesn't work that way unless you have a market crash situation, and we did, but I don't think so. Usually what's going to happen with this is you're going to see some of this froth be taken off, dribbling down here, and you get this sort of cup and handle movement to the upside. Financials should do well in the coming environment over time. People have been talking that for a while. That's why they were very strong these last couple of weeks. And it's just something to keep in mind for the future. And last but not least, we'll look at industrials just to throw one more in there. Again, fantastic pattern, 100% retracement of the prior down move and already showing signs of tight consolidation right up at the prior high, which is good. And also what I like about these types of patterns, I trade this stuff all the time where I'll be looking for multiple touches. And so you can notice that this is resistance, this is resistance, this is resistance, this is resistance, this one. Do you see how it's all at the exact, I wouldn't say exact same level, but roughly the same area? That's important because it's the, you know, knock enough times and the door will open theory, which is, you know, very, very important in the markets. That's just how things work. So I believe that we will see some sort of move higher in the industrials, and they are also a decent amount of weight in the S&P 500. Okay, now getting a little bit more granular. I like to use that word granular because the market really does operate in different levels of granularity, from what they call top-down trading, so to speak, where there's a 30,000-foot view where we might be looking at monthly charts, let's say, of the S&P 500, and we can go down to weeklies and we can go down to dailies. And then, like I was saying, when we were looking at the S&P chart, we get a little more granular by not switching time frame, but rather switching into sectors, which are the underlying underpinnings of the S&P, right? When we looked at financials and consumer discretionary and all that stuff, right? But then the next level, what I feel is like the final stage of granularity, is not really going down to like a 1 or 2 minute chart. It's getting into market profile, because the market profile is really the deepest look at the market because of the way that it brings us that added dimension of time as opposed to just price and volume, right? The candlestick charts, the technical analysis that we do without market profile is very flat. It's just two-dimensional because all we know is what the price was and what the volume was. But within the time that was spent in each candle, we don't know how much time was spent at each exact price. And that's the magic of what market profile brings us. And because we know how much time was spent at each price, we can then also sort of organize the information in a much more relevant manner, which will tell us where value is. So what I wanted to focus on is this concept of value in this video, especially as it pertains to this particular trading week. So I've boxed off the 5 sessions of the week, and the yellow areas are called the value area, as we know, which means that it is where roughly 70% of the day's volume or time spent, and just as a little caveat, I calculate my value areas using volume, not time, but at the same time, I pay a lot of attention to where time is spent. That means that even though these yellow areas are calculated according to 70% of the volume of the day, I'm also very, very cognizant of where the profile is fat and where it's narrow, right? Each letter is a TPO period, which tells us that for that 30-minute period, price marked at that spot, right? So we know if lots of letters are going across, you have lots of 30-minute periods at that spot. And of course, wherever you see these very faint green areas where the letters are colored in green, that is the point of control, which is where the greatest amount of volume traded during any particular session. So what my focus is here currently on the market profile is this concept of value and this concept of balance. even if you don't know a whole lot about this, you can clearly see that the market is in balance. We literally balanced for 4 out of the 5 days of the week. Monday was a little bit of a pop to the upside, and then after that, you notice that the value was just completely overlapping the whole time. Notice how these 4 value areas here have so much in common. And what was even more incredible about this week, and kind of ultra rare, is the fact that 4 of the 5 settlements were literally identical. That almost never happens. So what you're seeing there in the red rectangles are the closing prices at 4:15 p.m. of the ES E-mini futures. And at 4:15 p.m. on Monday, Tuesday, Wednesday, and Thursday, notice that it was literally unchanged. Just something to think about. What is the main takeaway from that? Honestly, nothing other than the fact that the market was in balance during that period. One of the things that I talked about in the pre-market perspective of Friday morning, which was talking about this overnight session, because obviously that's Thursday night. One of the things that I was mentioning to my subscribers in that report was the fact that all overnight distributions, the pattern of those overnight distributions has far less import and weight than the pattern of a regular trading hours distribution. But that being said, I always like to pay attention to those overnight distributions because they do give you some clues as to what's going on. And when I came into the market on Friday morning, I knew that it would be difficult for the market to do anything coming into the end of the week because of the way that the overnight distribution was setting up, where, as you can see, it was very, very symmetrical, very, perfect bell curve shaped, right? And look at how fat it was in the middle. And where was the meat of it? The meat of the overnight distribution was basically the same spot where the meat of the prior 3 days was in terms of the regular trading hour sessions. So that gives you a lot of information. And that's why I keep telling everybody, and I stand behind this, I really think that the report that I write every morning, telling you the key levels and telling you the scenarios and spending just a little bit of time in like 2 or 3 short paragraphs, you can literally read the report in 60 seconds, talking about the nuances that you need to be looking for every morning are worth their weight in gold. I mean, it is so important to know about this stuff so that you don't be caught in the shock and awe of the open where things just rip in one direction or the other, or they stay flat and not move, and you don't really understand why, because you don't have a full-on grasp of that concept of time, of value, etc., which is just so important to tell you what the market's going to do. And lo and behold, the majority of Friday, except for a very, very short period at the end of the day, which we'll get to in a second, did what? It did exactly what I expected, which was continued balance. Because a lot of times the tone and pattern of the overnight distribution will point to that, will tell you that if you stay in balance overnight, a lot of times the odds are pretty strong you're going to stay in balance in the regular trading hour session. It just happens that way. There's a lot of clues that can be gleaned from overnight sessions that way. So anyway, a lot of balance in the markets. Balance rules are going to be in play. If you don't know what the balance rules are, I highly recommend that you switch over to here and go to ShadowTrader.net and check it out down here. If you scroll all the way down, hit our glossary, because these are going to be in play in the coming week. We just started to break out of balance on Friday late. There was that spike. That's also going to put spike rules into play. But if we look at balance rules, it basically just tells us very finite rules, very concrete, very absolute rules for what the market could do next week, right? So if you read here along with me, I'm not going to read the whole thing. We can either look above and go outside of the balance area. Target should be then double the balance area, right? Whatever that was, added on to the top. We could look above and fail. That means we will come out, we'll go back into balance. Then we target the opposing end of balance, right? And then the rest are for bearish. If we look below and go, which doesn't look like imminent now, but if we went to the bottom end of balance, broke below, went back in, we'd go back to the top, look below and fail, etc., etc. Or, as always, the door number 3, as I call it, we could remain in balance. But since we've already broken out of balance, we now, it's probably not so common that we're going to stay in balance since it's already happened. We've already broken out late Friday, so we're not going to pay too much attention to that rule. But what we are going to pay attention to are the spike rules, right, which are here. These are going to be in play as well. And I'm going to go back to the market profile chart and show it to you in a second because of the spike rules. And what is a spike? It is simply when you have a surge of prices higher or lower very late in the day. And because the spike forms late in the day, and I'm just literally reading from our definition here, it is impossible to gauge whether or not those higher or lower prices that ran quickly away from value will be deemed fair later. Thus, we have to employ spike rules in the next session. And what are the spike rules? Well, the spike rules are simply that we're just going to look at this area here of the spike, which is the single prints here. We're going to look at it very, very closely on Monday. I keep saying Monday, I apologize. It should be Tuesday's trade because Monday is the day off. On Tuesday's trade, we're going to look at this very carefully, and we're going to look at it in terms of the spike rules. Spike rules are going to tell us this, basically. If we open above the spike and we find acceptance, that is the most bullish outcome. That tells us that the market is very bullish, and what it's doing is it's telling us that the higher prices of the spike are being more than accepted. They're not only being accepted, it's higher than those prices. That tells us that those late day traders on Friday did the right thing. They didn't act out of panic or emotion. They're going to be deemed right. Okay, if we open up inside of the spike and we hold there, that's also bullish, but not as bullish as going outside of it. If we open up below the spike, that's the most bearish outcome. Basically, what that does is it negates the activity of the spike and tells us that this was just a lot of BS, and we're actually going to open down here. And if we do open down there, remember, that tells us a lot about the potential balance rules, because remember, that would deem a lot of this activity that we saw here as a look above and fail. And as we know, how do we play a look above and fail? We target the opposing end of balance. All right, so these are the important frameworks that you need to be looking at for next week, and it's really a good way to trade. These things are so important to know, and that's why I teach these concepts every single morning in my pre-market perspective, which is literally the best value on Wall Street. For 20 bucks a month, $1 a day, you get this report. I point out all these nuances, and it really sets you on the right track for how you're going to navigate your day, because you now have absolute concrete scenarios, choices, frameworks to work, to trade within, of how the day could potentially play out. Remember, I don't know how the day is going to play out, but I work from a framework of all of the potentiality of what could happen in the day. Thereby, when one of those things happens, and it's always going to be one of them, I am not surprised. I am able to handle it in a cool, calm, and collected manner, and able to profit from it rather than be scared of it, or et cetera, et cetera. All right, let's get into a little trade of the week. I don't want to spend too much time on this, but it is kind of cool, and it is another sort of thing you can have in your arsenal. I want to point out this particular trade. Not a huge winner. Netflix this week, but it started out as a 1/3 call ratio. So what does that mean? That means we were buying the 582.50 calls one time, and we were selling the 600 calls 3 times. So it was a 1/3 call ratio, and we did that overall 8 times. So these were all of the entries here. And of course, because the trade was lots more sold than bought, the reason you do something like that is so that you can enter at a very, very advantageous price of either 0 or a tiny debit, or even sometimes a small credit. So you can see here the first 2 were put on at 0, the next 4 were put on for a 5-cent debit, and the last 2 were put on at 0 again. Let's take a quick look at a chart to understand what I was looking at and thinking in the Netflix trade. Obviously, these are the 5 days here. So what I was looking at basically is the simple fact that there is strong resistance at just under the 600 level in Netflix. So what was my thought process? Well, Netflix could go higher this week, but it's not going to go past 600, and it even has resistance just below 600. So what I was looking at basically was that it would be a 582.50 right here. I'll draw this properly. Hold on one second. A 582.50 one time, and the 600s were 3 times, right? So you can think of it that way. So long 1 and 3 short here, and then obviously the game plan was would the stock be somewhere in between here, or even close to 580 would be just fine. Remember, the beauty of ratio spreads, especially when they're 1/3s, is you don't need to move into the sweet spot. There's tons of money to be made just going close to your long option. Never mind your short options. Just getting close to your long options can bring you lots of money with ratios, because you have the power and leverage of all those options that you're short at the top draining out moment by moment. Remember, every day that's a sideways day when you put on a ratio is a day in your favor, because the options that you're short of have drained a lot more theta, because they are not only further away, because there's so many more of them than the one you are long of. So basically what happened with Netflix was the stock basically failed to rally over the course of the week, and it just kind of dribbled sideways to higher, and it wasn't enough. By the time we got to around Thursday or so, it was not enough to have any significant value in the 580-250. So what I did in this case is, instead of just closing the whole thing, I took the 580-250s and I turned them into a vertical. I sold them as a vertical for 40 cents. And as you can see, that's where the whole profit in the trade was. So what did that actually do? Is basically, instead of leaving the 600s to be naked for an entire day, because you can see I did this on 211. What I did is I sold it as a vertical, and what that ended up doing is leaving us long at the 597.50, right? Because I transferred the long from 582.50 to 597.50, and then at the 600 we remained short the three options, basically. And the purpose of that was to take in the credit that was gotten for selling the 580-250, 597.50 call vertical, and still leaving a little bit of protection just in case Netflix would, do something crazy and, whatever, run on some huge spike or whatever. And as you can see, that trade would have been just a break even, because we put it on for 0. We would have taken it off for 0, but that adjustment was what allowed us to, pull out a decent profit of 40 cents per contract out of the trade, right? And I do have some other ones in the same vein going for next week. That's actually a trade that I consider rinse repeat, because I like it so much. So you can see here that starting on Thursday and Friday, I actually got into the same trade again, this time for a little bit of a credit. So I actually took in some money. And interestingly enough, just due to the way how Netflix was pricing, a lot of times ratios, the entry is all about timing. You have to have good timing in order to make it free. And what's interesting is now, with only 4 days to expiry, notice that I'm a lot wider. So I actually got a credit, put the trade on slightly cheaper, but instead of having 82.50 to 600, right, which would be $17.50 of potential profit, I actually have $25 of potential profit, because I'm long 575 and short at 600. And remember, the entire game is that I don't need to get up to 600. I just need to really just hang around here would be just fine. And if I can do that same adjustment next week, I'll do it again, where I'll just sell the 575 call and I'll buy the 597.50 call, turning that into a much smaller 1/3 ratio of 97 to 600, and take in probably a larger credit than I did last week for doing so. All right. This was actually, just to wrap up this section, this was actually a relatively busy week, and I wanted to point that out. If you like, you can always just pause the video. You can see exactly what type of trades I do live with folks in the weekly options advisory. The only ones that are open are the ones in green. So I've got an interesting trade going on LVS call ratio, put on a really interesting broken wing butterfly on AMD, because semiconductors are really kind of on the move this week. So I'm looking at a 95, 97, 50, 106 call broken wing butterfly. I think that trade is going to do very well. It's already expanded just into the end of Friday. I've got a directional one on Facebook. I got a bearish bet on Google, which probably is not going to play out, because when I get into the next part of the video, actually in Google, by the end of Friday, by the time the week ended, not when I put this on, but Google was looking very great. I think it looks very bullish. But the beauty of this being a bearish bet is it didn't cost anything. If it goes to 0, it doesn't matter. So it's just fine. That's the way I like to trade, where winning trades are winning trades. Not a lot of home runs. I do hit singles constantly. and losing trades are very tiny losers or break even, and that to me is the epitome of consistency. That's what I like to do. So anyway, feel free to go through this. If you're not a member yet of my options advisory, you want to see what kind of stuff we do, you can kind of model some of these trades if you like in the Analyze tab or whatever you like. I'm not a big fan of the Analyze tab, but I know a lot of people like that in order to kind of get an idea. But I still always like to tell people that if you are an options trader that only figures things out vis-a-vis the Analyze tab, you really owe it to yourself to stop using that and get yourself acclimated for where options make and lose money just by looking at the strikes and just by looking at how much time to expiry. And you should know immediately just by looking at it, say, aha, if it goes here, I'm in trouble. If it goes here, I make money. If it does nothing, this is what's going to happen. If you're going to be an options trader and do this full time, you really need to know these things. So I invite you, if you like, take a look at what I got going on currently. Again, the stuff in green is what's open. The stuff that's not in green is closed. And see where these trades make and lose money and whether you think they make sense or not, where the risk is, where the profit lies, et cetera, et cetera. And last but not least, let's get into some trade ideas. So a lot of this stuff I'm already in. Netflix, I think, could dribble higher over the course of the week. AMD, I already talked about. Again, a lot of these are trades I already have. You can see on AMD, I've put a little box here for where my profit area is for next week, which is kind of interesting because it's really a wide profit zone, I think, for a shortened 4-day trading week. And yet, remember, it didn't cost me anything. So this structure was put on for free. And think about it, it's going to win anywhere in this box. And I like that. That's pretty good odds. What else do I have on? I have some bullish put sales in Amazon. Don't need to talk about that. That's kind of boring. Facebook, I think, could go a little bit higher, but not higher than the trend channel. I think there's this classic channel resistance up there. I mentioned Google, which I put on a bearish bet only because it was kind of a long shot that maybe it somehow fills the gap. I don't think so. One thing I'd be looking for is the fact that these two resistances are kind of equal. Stock could go higher, but I'm not a big fan of like piling into this stuff when there's already a large unfilled gap below us. I feel like those unfilled gaps can sometimes be problematic. Another one that I was looking at was Qualcomm. Maybe potentially breaking out of this balance, but to be honest with you, I'd rather do a bearish play. If it was to fall back down, I like the fact that you have support here, and I like the fact you're probably going to get some support at the bottom of the gap. What else is on my list? Oh, it wouldn't be proper, I should say, for lack of a better word, if I didn't talk about Bitcoin. Bitcoin almost hit $50,000 a coin. You can see I've got a limit order here to buy a futures contract on the pullback to the prior high. Who knows if I get that? It's probably just going to Spalding me and I'll get nothing and like it. And, we had a little bit of pullback here, almost happened. Probably what I ought to do is maybe cancel this order because this could have been the pullback and that was it. Remember, I'm a big believer that if something comes close to your limit order, but you don't get there, that was it. Basically, that was the pullback. And now if it pulls back again, it's probably going to go lower. So I'm going to watch this carefully, and I may actually cancel that. Anywhere in this area would be a fantastic buy because obviously it has the support of the dominant ascending trend line here. We shall see. And last but not least, obviously, if you're going to talk about Bitcoin, you got to talk about Riot. Riot literally doubled over the course of the week. Hit over 50. This stock is absolutely on fire. If Bitcoin stays where it is, doesn't pull back, I think every pullback in this stock is viable. It's going to be very volatile now, and you're going to get some good swings, some good bang for your buck on probably any pullbacks for bounces. Best case scenario would obviously be the pullback to the prior high, but barring that, we could obviously be looking at some Fibonacci's like from the breakout level from the prior high. Where it could go halfway back would take us to about 41. That would be a good buy. Obviously, the trend line support would be good as well. Who knows if we get there? That's close to the 61.8, which I like. There's a confluence of support there. That would obviously be a very strong buy. So all stuff to be looking at for the shortened trading week next week. And that's all for this week. Thank you, as always, for spending a little bit of your weekend with me. So let's just recap some of the things that we talked about. We have started to peak to the upside out of a large balance area, which was 4.5, 5 days, however you look at it, in the S&P. Balance rules are going to be in play next week, as are spike rules. All right, so if you're not familiar with all that, check our website on the glossary, which I showed you in the video. All right, next week is a shortened trading week. Tuesday is when we come back. Monday is going to be a day off for President's Day. All right, if you enjoyed some of the stuff that you saw in the video, such as my analysis of the market profile, or the adjustment that I made in the trade of the week on Netflix, remember, you can join me live and do all that stuff in real time with me. I send out a market profile report every single morning called the Peters Pre-Market Perspective, $20 a month. You can also take a 5-day free trial for that. You can read it for a week and see what you think. Just check that out on our site. And if you subscribe to the Weekly Options Advisory, where you can get my trades in real time sent as alerts to your mobile phone, I'll include that Peters Pre-Market Perspective newsletter for free in with your subscription. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.